Hello, everyone. Thank you for attending. Welcome to another Zoom podcast. And my name is Seewing Yee from the Yee Real Estate Network. And my special guest is Maureen McCann from Spartan Invest. And today we are going to talk about why the real estate investors out there are doing so well in today's real estate market environment. So without further ado, thank you for attending, Maureen. Thank you for your time and appreciate how busy you are doing your business and appreciate that. So without further ado, listen, a real estate investor, the way a serious real estate investor, a turnkey real estate investor, or mom and pop real estate investor, if you will, for those of you out there, at least the one we work with, right? We work with mom and pop real estate investors. Be it most of our investors in California and Maureen, you have investors that purchase your properties in your market in Alabama and Tennessee from all over the country and even all over the world. So, and here's the thing, right? I mean, on the one hand, there's a huge difference between a primary homeowner or a owner-occupied buyer versus an investor. It's really, think about it, it's difference between night and day. What does it mean? That means a primary home buyer, they buy a home for $500,000 or $1 million, and they have to rely, they're living there. They're living at their home, so they have a very emotional connection to their homes that they're living in for themselves and their family and children, whatever. And they are buying at whatever, 10% down, 20% down on a house that they're living, where their paycheck, right? They are allocating like 1/3 or 1/4 of their paycheck to pay their mortgage payment, right? To live, to buy the house to live, right? So, yeah, so those primary home buyers, they have a lot of fear, they have to, they hear all the negativity out there. Is that recession coming? Inflation is at historical high, and is there a bubble? Is there a real estate crash? And there's a lot of fear mongers out there. There's a lot of naysayers, a lot of negativity. All the the news media and the YouTube videos, they all talk about the doom and gloom scenario. So, but a real estate investor is different, right? Our mindset is that we are not even think about the interest rate in a way that other people, in a way that home buyers think about the rising interest rate. So a real estate investors, they look at the yield, right? The return on the investment. They look at the rent to value ratio. They look at a capitalization rate. And so they have to ask themselves, if they're able to put down 20 or 25% down payment, right? They have to ask themselves, are they going to achieve little bit positive cash flow at 20 to 25% down payment, meaning the rent they can project their renter going to pay, is it going to pay for their the owners, the investors' mortgage, taxes, insurance, property management fee, and 5% vacancy and 5% maintenance costs. And at the end of the month, you can achieve a little bit of positive cash flow, and then ride the wave of long-term investing and allow the investor to pay down the mortgage. And, really, I mean, that's all the risk that are necessary. 20 to 24% down, that's all the upfront risk the investor has to do. The rest is gravy, right? So before we go any further, let's look at some of these charts. Investors recently are buying a record 90,000 homes in the third quarter of 2021. Risk investors are buying low price homes, right? You have to know the limit. And in my mind, I'm sure you'll agree, the single family homes are the best asset class. Risk investors, they like to focus on single family homes that are less than $400,000, so up to 400,000, because the rent match the numbers, right? So I'm sure you agree. So lower price homes, that's the benchmark. That's the tipping point, if you will. Now, here's another thing. The mom and pop real estate investors, you are competing against those big boys out there, the institutional investors. They are using the built to rent business model. What I mean by that is Wall Street, they are putting billion, as you can see, $40 billion or whatever. They buying a whole bunch of homes in a community throughout the country, mainly in the Sun Belt, Phoenix, Arizona, Las Vegas, Nevada, and Boise, Idaho, and then Texas and Florida and North Carolina, and in different places, right? So single family homes, this build to rent business model that are initiated by these Wall Street institutional investors. So and so they buy this kind of homes because they know they see the return, right? They see the yield makes sense to them. So they are a big player in the market. So there's a lot of competition for single family home investment asset class, if you will. So furthermore, again, like a lot of the national builders, they are also in a game, right? They are building 400 homes, for example, in a community, and sell it to Wall Street, the hedge funds, whatever, and when they finish building, they rent it out to renters to live there as tenants. So it's a $60 billion housing grab. So Wall Street is entering Main Street. Some of the companies, I'm sure, Maureen, you have followed, the similar trends. BlackRock, right? They're the big players in this game, and then we have few other institutions that, from time to time, have entered the residential real estate investment market. So we're talking big players, 9 trillion. So JP Morgan, Chase, same thing. I mean, and so what we're trying to say is the mom and pop investors, Maureen, that you and I work with, we are playing in this a very competitive game, right? It's just it's a lack of homes, as we all know, record low inventory, high buyer demand, even a 5% interest rate. Listen, 5% interest rate currently, even slightly higher, is not going to affect real estate investors that much. A primary home buyers, yes, that will disqualify a certain percentage of a owner-occupied buyer. Primary home buyers nowadays, they they can't enter the market. So there will be less demand these days, but the record low supply still is a key trigger to determine that the housing is slowing down a little bit, but still a seller's market, still very strong demand. It's just a little bit less buyers, a little bit less multiple offers in my mind, because the home sellers are not selling because they locked in on a low interest rate a year and a half ago at 2.5%. Now it's 5%. So they're not going to sell their homes to upgrade to a new home where they have to pay a lot higher mortgage payment, right? 5% from 2.5. So they are staying put. The sellers are not going to sell. Very few are selling these days. And builders are now building enough homes to make up the vast gap between supply and demand. So as an investor, we do what we can, right? We find a way either to stay in a market, to compete out there. Risk investors, not only mom and pop investors that you and I work with quite a bit, Maureen, but foreign investors, they are about to plunge into this market as well, right? In fact, over the years, many foreign investors have entered the U.S. market to buy this type of single-family homes for us as an investment, and they pay with all cash. So, mom and pop investors, you have the 20 to 30% down payment. You can pay 50% down payment for more cash flow. You can pay, in fact, a quarter of all investors, they buy with cash. They have deep pockets, right? So that's what's going on in the world, and the sweet spot for home pricing, as you can see right here, this home in Florida, like $375,000. If it rents for $2,500, and it will, this is the highest end, that's a tipping point, to the lowest end, which is this type of property around new construction, around 250K. So this is the type of homes that everybody's chasing, right? So and the question is, the really smart investors, they go after the off-market type of opportunities. They don't go to, they try. Okay, normally you compete in a multiple listing service, right? You compete against everybody, and we all know how challenging that is, right? Multiple offers and, you know, crazy, very hard to find homes. You oftentimes you do away with appraisal contingencies, inspection, or just to get into a house. Is crazy out there. So if an investor is smart enough to hook up with an organization that have off-market opportunities, then it's a major win for them. All right, enough said. I want to hear your thoughts from now on. I'll talk too much.
All that you said is very relevant in today's market. We've got we've got less than 1.2 months of supply. We need 7 months or more in order to be in a buyer's market. Some of these funny memes that I've seen, you know, coming across. This funny one that I just saw recently was it was a real estate agent on the phone talking with another agent, you know, seller buyer agent, about this is in 2016. Okay, so we want an appraisal, we want a home inspection contingency, we want the buyer to pay $3,500 towards closing costs. We want, the roof is showing a little age, so we want about $20,000 off the price. And you just see it was like nickel and diming and taking everything away and having all these contingencies. And today, the funny meme is that same real estate agent selling that same property today is, okay, yeah, don't worry, we don't need appraisal, we don't need a home inspection contingency, we'll pay $400, pay cash, we'll close it now. Let's do it, right? And so it's just it's the time that we are in at this moment. I don't know how long you've been in real estate. It's been 13 years for me in the rental real estate world. This is what I know. I've seen the trends over 13 years. I've never seen a decrease in the demand for rental houses, either from a renter's perspective or even from an investor's perspective. And you showed that graph of 90,000 units sold in Q3 of 2021. There is a reason there is a very strong reason why there are so many investors that are going after the very little inventory that's out there. And it's because look at what we're paying in inflation right now, right? Our inflationary rate is high. It's probably going to go higher. We don't really know where it's going to end up, but we just know things are costing us more. It's costing more money to buy, to finance rental properties. It's costing more in rent. You mentioned the number of first-time home buyers that are getting outpriced, or there's not enough inventory to buy. Those are more probably the millennials and the Gen Zers that are really getting into the first-time home buying, want to capitalize on the low rates. But as the rates are rising, this is exactly what the Fed wants to do. They want to slow the growth. So if you raise rates, then you slow growth, then you can start decrease inflation. So it pushes people that are on the margins out of the market, is what those higher interest rates does. And it offers the opportunity for the real players who are, again, if we tie in the first module, those 1%ers who are looking at the opportunity and not looking at the cost of money, right? The cost of money is going up, but rents are going up. The number of people that cannot buy now, they have to rent. So there's more demand on the rental side. And investors that know real estate, they know this, and this is why you've got record sales in Q3 of 2021. I have not seen on the selling side of turnkey rental properties, I don't have enough properties to deliver fast enough for the demand. This is true in my business. If I had 1,000 doors, I know that I could sell them in a very, very short period of time. But that's not the case because, like you said, there are those bigger competitors. Why do you think the BlackRocks and the JP Morgan Chases are getting into investment real estate? Why are these big dogs who all tote Wall Street, right? Why are they directing money and trillions of dollars into single family rental properties? What do they know that you don't know, right? And if you listen into see, when you tune into him, you will learn the 5 ways that real estate pays you. It's just not about the cash flow. And I think this would be a good maybe summary point here. I have been doing this long enough to know that in turnkey rental properties, you talk cash flow all day long. You don't speculate, you don't buy on speculation, you don't buy on the presumed capital appreciation that is coming at some point in the future. This is what you do not do, right? And I have not done for years. Guess what? The conversation is changing now. Here's why it's changing. Before, I'll just take Birmingham, Alabama, for example. Capital appreciation in these markets, very, very moderate. And trucks along, year after year, not subject to the wild swings in capital appreciation in markets like California. You could buy a house today in California, and a year from now, it appreciated $500,000, and all you did was hold the note and put 20% down, right? This is what real estate investors know with investment property is it doesn't matter if it's your primary, it doesn't matter if it's your real estate holdings, your rental properties, capital appreciation exists in some markets more so than others. And so where the conversation has switched for me from years and years of talking about high cash flow, because we were in record low interest rates, like we were below 4% for almost 10 years. And even longer than that, right? So we're all spoiled little, real estate investment girls. I want high cash flow and I want capital appreciation. Well, before you got high cash flow, low capital appreciation, we're right now in a situation where the cash flow is not as good as it was before, but after all expenses, it is still cash flowing. And you're getting double-digit capital appreciation, or I call it home equity. You are getting double digit in our markets, and in some areas 20% or greater. So your $100,000 house, buy today, 12 months from now, let's say you bought it 12 months ago, right? That $100,000 house, if it appreciated, the National Association of Realtors across the United States said 19.1%. That was across the US. In my markets, I've seen 20 to 26%. So let's just take 20% to split the difference, right? $100,000 house that you bought a year ago for $20,000 down. It appreciated 20% or $20,000 in 12 months. That is 100% rate of return on your money on capital appreciation, not including cash flow, depreciation, and loan pay down benefit, and the hedge against inflation. So this is why the 1% take action and the 99% sit on the sideline, because they don't know it. It's just ignorance. It's a lack of education. Listen to Seewing. He will educate you so you will take action and not be fearful.
That segue into our next presentation will further elaborate what you just said. Such a coincidence. Wow, where is this coming from? But before we segue into another podcast, talk about this very same thing. My recap is this. So as an investor, or you can play the game of multiple listing service, competing against everybody out there in the investment world all over the US, or you're going to hook up with a network that will supply you with off-market opportunities where there's no bidding involved. Well, guys, you're talking to both of us. Myself, Seewing Yee from Yee Real Estate Network, and Maureen McCann from Spartan Invest. So we're not gonna go to anything specific. You will know our information at the bottom of our description, how to reach out to us. So with that said, thank you so much, Maureen, for providing a very, very good recap. It makes total sense. Real estate is history's most attractive, most proven, multi-dimensional investment asset class. That's it. That's all you need to know, okay? Thank you so much.